ಇಂಟ್ರೆಸ್ಟಿಂಗ್ ಮಾತಾಡ್ಬಿಟ್ಟು ಆಮೇಲೆ ಕ್ಯಾಮ್ರಾ ಆಫ್ ಮಾಡ್ಬಿಟ್ಟು ಆಮೇಲೆ ಕಂಟಿನ್ಯೂ. It's already in live now.
Hello. Good morning, everybody. This is Professor Nagendra Babu, Professor of Commerce, PG Department of Commerce, University of Mysore, Mysore. Today I am going to speak to you on financial planning, the very important topic where we are being concerned about as to how an individual or an investor has to plan his financial analysis. To start with, to say a few words, this particular financial planning is very important because if anyone wants to live comfortably during his lifetime or even after the retirement period, he has to plan his financial planning in a very smart way. Smart way in the sense, we should see that whatever the solutions that we are going to get for the whatever the income that we are going to have, these things are going to be taken into consideration because we have to invest a part of our earnings in our assets where they are going to bear some income in the days to come. Why this particular thing becomes very much important? It is because we take into consideration whatever the investment that we are going to make, it should be in a position to bear some income for us in the days to come. Now, this particular financial planning, we can define it as a process, a never-ending process, we can say, because a particular person soon after his education will go for investment. The first thing that he thinks about is in which particular financial assets or in which particular assets I have to make investment so that they are going to give some income for us. This particular financial planning is very much required for us because we have to lead a stressful life. Why we require a stressful life? Because when we don't plan the things in a proper manner, we will not be in a position to lead our life in a very comfortable manner. It doesn't mean that we have to lead a very luxurious life because we are all salaried class people, even the businessmen, even a particular person, an average bread earner for his family, thinks of that he has to make certain investment in the days to come, and that particular investment is very much required because we have to lead a stress-free life in the days to come. Now, when we take into consideration these particular things into consideration, the financial planning becomes very much important because we have to save the money in a very smart manner and we have to invest in the good income bearing assets in the days to come. That means to say, like the government, where it is going to prepare the budget, the government is going to prepare the budget because it is going to plan for next 1 year what the amount of income that the government is going to receive and what the amount of expenditure that the government is likely to incur on the various projects. So we see the central government of India, through its finance ministry, the finance minister is going to prepare the budget and it is going to be presented in the Lok Sabha and Rajya Sabha, and it is going to be sent for assent for the President of India. Similar is the case in the state level also. The finance minister in the state level is going to prepare the financial budget, what the income and the expenditure that they are going to get and spend, and that is going to be sent for the approval of the governor in the state. Similarly, a particular bread earner, a person who is earning money for his family, is going to plan the budget for his 1 year, or every month he is going to prepare what is the likely expenditure and all those things. So let us think on this particular way as to which is the right investment and how the wealth is going to be created by a particular individual. So we take into consideration what is financial planning. The definition part of the financial planning refers to a comprehensive plan of your long-term or short-term objectives for financial security. So the purpose of financial planning is to form the, the foundation for a specific goal or destination in our life. The next important aspect that we are going to cover is how to do financial planning very successfully. So the financial planning is going to be very successful when we take into consideration we ourselves can be a financial advisor, or we can hire a particular person who is going to be a financial advisor for us, and we can pay a small amount of the remuneration for whatever the consultancy job that he is going to do for us. And the financial planning includes the following aspects. Number one, establish a goal. So ask yourself questions regarding what kind of future you are aiming, how much you want to spend, and all those things. Usually, if 100 rupees is the income for an individual for a month or for a year, we can segregate that particular 100 rupees into 30 rupees for the expenditure that he is going to incur in the routine manner, another 30% for whatever the debts that he has borrowed or whatever the liabilities that he has got for the assets that he has created, and 10% for the entertainment purpose, and another 30% he can make safe investment. Like that, the segregation can be done, and this is going to be the right choice in my own personal view, because out of 100 rupees, 30% goes for the expenditure that you are likely to incur for the household expenses, whatever the commitment that you have got in the form of the education to your children, education for yourself or the spouse, daily expenses that you are going to incur for the family, and whatever the small amount of money that you are going to spend on the printing and stationery and all those things. So 30% goes for the household expenses. Another 30% for the assets that you have created for which you have borrowed the loans, and that loans are to be repaid. So 30% will go in that way. Another 30% you are going to make investment, and the remaining 10% you have to spend for the entertainment purpose. This is going to be a very good financial planning. So what are the things that you have to take into consideration? The first one is you have to establish a goal. What is that goal that you require? Because it is your immediate or long-term financial goals for efficient financial planning. Many people often begin to save or invest with no specific goal in mind and end up spending the amount. And the children will be looking at why my father or my mother is not spending, and they are all creating the assets, and whatever the amount that they are earning, everything is going for the asset creation only, and they are finding very troublesome, very difficult to spend for our expenses in a comfortable manner. The children will be observing. That should not happen, because you have to spend the money with a particular object or with a particular goal. So you have to gather relevant information, because why you have to gather relevant information? It is because you have to look into that what are the different financial instruments that are there available in the primary market or in the secondary market, whether it is good for you to make investment in post office, or it is good to make investment in the fixed deposit, or it is good to make investment in post office savings bank account, or it is good to make investment in the IPOs, that is initial public offerings, or you have to make some investment in the equities or in the debentures that are in the bonds in the stock markets. That is all left to you. As a commerce student, you should be in a position to understand that these things becomes very much important, because some people will be risk averse, we call them, as they do not want to take any particular risk at all. And some people will come forward, a little percentage of the people, they want to take the risk, because in the economics we study that more the risk that you are going to take for the investment purpose, or in the instruments where you are likely to invest your money, more is the risk, then more is the return for you. Because if you make if you are very much risk averse and you do not want to take any what we say, that you do not want to take up more risk, means it is better for you to go and deposit your money in the bank. If you deposit the money in the bank, usually the bank people will give you a nominal rate of interest. Say, for example, on the savings bank account, at present, we are going to get some 3.5% or 4% hardly. That is the maximum interest on the savings bank. And in the fixed deposits, in the scheduled commercial banks, you see like State Bank of India, Canara Bank, Syndicate Bank, if you make investment, you are going to get a investment, that is the rate of return will be something around 5% or 5.5%, and it depends on how much for a long period you are making the investment. So there are so many options that is being left out to a particular person as to what type of the investment he has to make, and which is going to be the right investment. It is very difficult to judge, because only when you enter into the market and study about the different financial portfolios, financial products, financial instruments that are available, over a period of time, you gather so much of information. Right now, some people may be thinking of that it is better to make investment in real estate. So, real estate means you make purchases of the sites and all those things within the city vicinity or in the outskirt of the city, and you think of that the site rates will go up like anything, and it will multiply in the days to come, and it is going to be the very good investment pattern for you. But there are certain chances, if you are making investment in the growing cities like Bangalore, Hyderabad, or Vishakhapatnam, or some other cities in Mysore, or in some other very important cities, there is some likelihood that you are going to make certain amount of profit over a period of time, because the sites on which you have made the investment is likely to yield something. But on the contrary, if you make investment in the buildings and all those things, you see, one house you can go for the construction, and you can avail the tax rebate and all those things. Second house, when you go for the option, you are going to have certain constraints and all those things, because your income should permit for you to make the investment in those particular issues. So we see that if you are planning for your children's education, analyze your annual incomes and future needs, and then research about the investment options available for the same. So it is wise to have an idea of your expectations to make a prudent decision. Next, you have to develop the plan. What the development of the plan that you are going to do? Developing the plan means devising alternative solutions that will help you achieve your goals through financial planning. With a variety of options to explore, make sure you choose an investment that aligns with your current needs and future requirements. Your risk appetite and other things are to be taken into consideration, because that happens to be the most crucial aspect to consider while making a financial plan. The fourth important is you have to implement the financial planning. So put the plan to work. How the plan is going to work out? You have to implement that plan. No, so you have to start investing in one or the other financial products. So this might be the most challenging step in financial planning. It requires discipline and the right mindset to begin investing in your plan. Do not let negative thoughts of failure which may distract you. So some things will come out in your mind, and it will be telling. You can also take the help of financial advisors for additional guidance. You do not need to start by making a high level of investment or savings. Begin by making small contributions. So the very important advice as a financial consultant that we are going to provide, who are going to seek certain advice from us, we say that don't make a very high investment, large investment in any one particular portfolio. Say investing all the money in the bank fixed deposit only, or making investment in all equity markets only, making investment in the debt market, or making deposits in mutual funds. So that particular high proportion of your income, when you are going to, or the investment you are going to make, your money is going to be locked up in that particular sense. So you have to be very very careful relating to this particular issue. Next comes what are the elements of financial planning and all those things. So we have got so many other issues that we have to take into consideration. So we have the mutual funds. So what are the financial elements as you are going to take into consideration the financial planning? The first one is the mutual funds. So mutual funds are nothing but the investment that you are going to carry out in a very small proportion. So there are so many companies which have come out for the purpose of making the are asking your investment to be made in the mutual funds. We have got SBI mutual funds, we have got Canara Bank mutual funds, and we have got the some other public sector mutual funds. Apart from the private sector, like we have got ICICI, we have got HDFC, we have got Tatas, we have got Birlas, where the mutual funds are going to be made available for the small investors. You can start investing a small proportion of your investment, say 300 or 500 rupees every month to a particular mutual fund. So SBI mutual fund, we have got so many options in the mutual funds that we are going to make investment. For example, we can make investment uh, in the tax saving scheme, or we can make investment in the capital gains, or we can make investment in the growth fund, or you can make investment in the balanced fund. Like that, so many options are there. So everything you look into or take the advice of the financial consultant to see that you are going to make a very shrewd investment. You see, mutual funds are market linked investments that invest your money in various instruments, including stocks, money market funds, and more. Mutual funds can prove to be a great addition to your financial planning. The next option or the element that is there in the financial planning is related to your public provident fund. So PPF we call it as. So who can open a public provident fund? Any public person can open the public provident fund. The name itself is going to is going to tell you that it is open for every public person who can make the investment. The rate of interest on the public fund is going to be slightly higher when compared to the other financial instruments other than debt and equity, because we see that this particular public provident fund is a good investment option if you are looking for tax rebates. It is a government backed investment scheme which allows you to enjoy risk free returns, and the maturity period under the plan is 15 years, but you can make partial withdrawals after 6 years. So the lock-in period is going to be 15 years, but you can start getting the withdrawal from your PPF after a period of 6 years or something like that. This particular thing is going to change according to whatever the rules and regulations that the government of India is going to give. And as per the directions received from the government of India, the alterations are going to be made with regard to the rate of interest or with regard to the procedure relating to the withdrawal and all those things. So the next important thing that you are going to claim, why people go for the public provident fund, it is only because they are going to get the tax rebate. Because always wherever you go, risk and return analysis is very much important. Why risk and return analysis is important? Because when you make investment in this particular different sources, you see that you are going to have certain advantages, because you may get more income also because of your income investment that is you are going to make in a particular financial instrument or a financial product. But over a period of time, what happens? You see that the risk is also be taken into consideration. Because always, as an investor, we have to look into not only the profitability point of view, but we have to look into the liquidity point of view and also the safety point of view. So, safety, liquidity, profitability, these are the three important things that we have to eye upon when we are going to make the investment in the financial portfolios. For example, you can see that you can get or claim deduction for the amount invested under Section 80C of the Income Tax Act 1961 when you are going to make investment in the public provident fund, that is PPF. The principal amount, high interest earned, and maturity amount is exempt from tax. Before making an investment decision, make sure to review your financial planning time to time. So whatever the principal amount that you have invested, whatever the interest that is being earned on your investment, and also the amount that you are going to receive in the form of the interest, all the three things are being exempt from the tax under Section 80C of the IT Act 1961. So the next important financial product that we are going to look into is the unit linked insurance plans. So these are being very popularly referred to as ULIPs. So what are ULIPs? They are nothing but the unit linked insurance plans that we take into consideration. Financial planning should include the mix of both investment and insurance for the overall security of you and your family. So when you are making the investment in the debts and in the equity market, or in the fixed deposits, your life is not secured. Your life is not insured, because you are just making an investment, and for whatever the investment that you are making, they are going to pay for you the regular amount of the interest and all those things. But who will take care of your life risk? It is only the insurance companies. So insurance is a contract where the insured life is going to be indemnified in the happening of an event. If a person is going to die, then the bread earner is no more. Then his family is going to be put into financial burden will be there, because the bread earner is no more. So at that particular time, the insurance company is going to compensate the insured family, the next kith and kin of that particular insured person, and the insurance company is going to be referred as the insurer. So whatever the money that you are going to pay every month or bi-monthly or quarterly, half yearly or yearly, it is going to be considered as whatever the premium that you are going to pay for indemnifying the loss that is going to be cost to you. So financial planning is going to be taken into consideration, and we see that this particular national pension scheme is another particular plan that is being taken up. Nowadays, after the uh, what we say 1st of April 2006, the government of India has brought a rule that no more pension is going to be paid as a social security for the government employees. So the old pension scheme, OPS, is not in practice. NPS is in practice. That is new pension plan. According to this plan, 10% of the amount of the salary that you are going to receive, net salary, or as per your rules and regulations of the government, the amount is going to be invested by the salaried person. A proportionate equal amount is also going to be invested by the government also. And when these particular government employees are going to retire, the interest earned on the investment made by these particular people are going to be paid to the retired person, a retiree we can call them as. Retired person is going to receive the regular income. So the new pension scheme is going to allow you, the salaried class people, to save a proportionate amount of their income by making investment in the new pension scheme. So the new pension scheme, we can say financial planning opens a long way to provide you with security and peace of mind, even in your retirement years also. It is therefore crucial that you manage your personal finance wisely from a young age itself. So you have to start immediately if you join, or you start earning at the age of 22 or 23. Then immediately you have to make a investment plan that it is you are going to receive the insured amount, or the whatever the investment that you have made, you are going to likely to get, if you make the LIC and all those things and take it for 30 years. So when you take up a policy at 23 years or 25 years, you are likely to receive all those particular amount before your retirement only, and you can use that particular money for whatever the expenses that you are going to incur. So you can see that a lot of benefits are going to be there when you are going to take up the financial investment at a very young age itself. And you see that you can make partial withdrawals up to 25% after 3 years of opening the account. So the National Pension Scheme allows gives tax benefits under Section 80 CCD. So that is subsection 1B. So you can think of what are the different options that are available as a financial consultant. You can give the advice for the person who comes for your advice. So the number one is we can take our plan for the mutual funds. So what is the return that the mutual funds are going to offer for you? They are going to give the market linked returns for you. So whatever they are going to earn when the mutual funds amount is going to be invested in the market, whatever the market earnings that is being done by the SBI mutual fund manager is going to distribute it accordingly to all the mutual fund investments. So it is always market linked or market driven. The next one is the tax benefits. That is, the tax benefits will be, it is you are going to get under section 80C, equity linked savings scheme tax free under section 80C. So that is being linked. You can get the tax rebates and all those things. And who can make the investment in this? Moderate to high risk tolerance is going to be there. So any person who comes forward for the purpose of making investment and who is ready to take up the risk, moderate to high risk, he can go for this particular type of the investment. The second one is the public provident fund. So what is the rate of interest that you can get? This is 7.1% at present, and it comes under income tax benefits also exempt category. That is, it falls under section 80, that is a triple E, that is taken care of, which is going to exempt the benefits that you are going to get on the public provident fund. Indian citizens with long-term investment goals, they can go for the purpose of making the investment in the public provident fund. The third element that I was explaining for you is with regard to the unit linked insurance plan. It varies on the investor's portfolio. So how much you want to make the investment on this particular portfolio, you can make. And the tax deduction is available for you under section 80C. And those looking for insurance cover and wealth creation, they can go for the unit linked insurance plan, because wealth is also created and the income is also generated, because you get both benefits. That is, your life is also covered, your risk is also covered, and you are being guaranteed with certain amount of income. The next financial element or the financial product that you look into is the National Pension Scheme, which we call as NPS. It is regulated market-based returns. So regulated market-based returns are going to be there. And tax deduction under section 80C, subsection 4, is going to make allowance for you, where your tax benefits are going to be accrued for the people who are going to make investment in the National Pension Scheme. And the type of the benefits that you are going to accrue, it is for retirement investment plans that you can think on these particular lines. Next, you are going to think about as to what are the tips that we can take for as related to the financial planning. So first one is determining the cash flow. That happens to be the very important tips in the financial planning or for the better financial planning, because you have to think of as to what is the cash flow for you, what is the cash inflow for you, and how much you can make investment in the financial portfolio. So for efficient financial planning, you need to know where your money is going every month. So keeping track of your spending and making notes can help you in this case. So checking your account and credit card balance is one way to ascertain the history of your spending. So you have to check your account and also the credit balance also to ascertain the history of your spending. It enables you to be conscious for any unnecessary withdrawals. Don't go and withdraw unnecessarily and use it for some unproductive purpose. The second one is creating an emergency fund. So you take into consideration, once you have mapped up your saving capacity, it is necessary to set up an emergency fund. People often tend to forget doing, as they do not think about the uncertainties of life that can happen anytime. So an emergency fund refers to the money set aside for times of crisis. So it will help you avoid borrowing when cash is required. It is ideal to set aside an amount during financial planning. So you have to create an emergency fund where in all what we say the life emergencies that may be there, whenever the problem arises, that particular amount can, which is being set aside, can be used, which is going to act as the emergency fund. And the second one is eliminating the debt. So as far as possible, you have to see whatever the debts that have been accumulated on you, for which you are making the payment and all those things. You have to see that as far as possible, the debts are to be eliminated. So after you have created an emergency fund, it is advisable to clear all your current or past debts, pay off each debts regardless of whatever the amount that is due. In turn, eliminates your monthly payments also, thus increasing your cash inflow. So when you clear off all your debts and all those things, it is going to provide you the regular cash inflow, because a part of the salary that you are getting was cut and it was debited towards the payment. So once you clear off all your debt, then the cash inflow for you every month, what you are getting, it is going to increase because you have cleared all your debts. Financial planning is all about making yourself independent of any monetary burden with organized personal finances. So you have to take care of that. You are going to be very independent, and whatever the burden that is going to be there, that you want to ease away with, and cutting on expenses. So whatever the unnecessary expenses that you are going to bear with, and whatever the unnecessary expenditure that is going to be there for you, those things are also going to be covered. So you take into consideration as to this particular unnecessary expenditures are to be taken care of, and you have to take whatever the unnecessary expenditure that is going to be there for you, that you have to see that those things are going to be curtailed, and you are going to put an effect to that particular extent, because unnecessary expenditure that is going to be there, that is not going to be taken into consideration. So you take into consideration whatever the unnecessary expenditure that is there, that is being taken care of. And the next important thing that we take into consideration is cutting these unnecessary expenses, whatever that is there, that is to be eliminated. Next one is considering your priorities. Whatever the expenditure that you are going to take into consideration, you have to take into consideration the priorities. Number one, number two, number three, number four, like that. You should have the financial priorities. Which particular urgency is there for which particular financial portfolio, or for which particular assets you want to be there. So you have to have the priorities for your development purpose, and also how you are going to keep your financial planning a successful one. You have to take into consideration that you are going to make investment in all the diversified portfolios, or in the different financial portfolios. For example, you have to take up the insurance policy on your life, you have to take up the medical insurance on your health, and you have to make investment in the fixed deposits in bank. You have to make certain portion of your investment in the mutual funds. You have to maintain certain amount of deposits in the equity market, or in the bonds, or the shares, or something like that, so that your risk is going to be diversified. So this is all about the financial planning. Next, we also take into consideration the different types of the fixed deposits and the other bank deposits that are going to be there. In a country like ours, we see India is going to be a country where you take into consideration that different bank deposits are being offered. So in the way, traditionally from the last 40 to 50 years, or from the day of inception of the Banking Companies Act, we have seen that usually the scheduled commercial banks and the commercial banks, they go for the wide variety of the deposits that are being offered. Usually the bank will allow you to make investment in the current accounts, fixed deposits account, savings bank deposits accounts, and all those things. So when the current account deposits, we say current account is likely to be opened by the merchant community people or the business community people, and this particular merchant community people, they don't have restriction on the number of types of the deposits that they are going to make, and a certain amount of withdrawals is also permitted in a week. They may withdraw at any point of time, whatever the money subject to whatever the rules and regulations that are there on the current account. So for the depositing of the money or for the withdrawing of the money, a very flexibility is there in the current accounts. Current accounts are normally opened by the merchant community people or the trading community people. The next comes the second one, that is the savings bank account. As the name itself is going to suggest to you that it is a savings bank. Savings bank means whatever the money that you are going to get in the form of the salary is going to be deposited to your SB account, and that amount is going to lie there. And from that account, you are going to withdraw the money for whatever the requirements that you have got and for whatever the financial expenditure that you want to meet. The savings bank deposits are going to provide a very nominal rate of interest for you. Say, for example, hardly you may get around 3% or 3.5% on your deposits or the balance that is there in the SB account. So we take into consideration what type of the bank account serves a lot of purposes for anyone in the process of financial planning is well taken. The three most important ones being safety, convenience, and the savings as such. Traditionally, in India, we have more major types of bank deposits, namely current accounts, savings accounts, recurring deposits, and fixed deposits, each with varying advantages. So you go opt for any one particular thing, it has got its own advantages and disadvantages. So, however, these days some banks have also introduced many new products which combine the features of two or more types of bank deposits, like two-in-one deposits, power saving deposits, smart deposits, etc. So, with the introduction of new products, there have been cases of increasing fraud in the bank accounts as well. So, to safeguard yourself and to see these frauds, we have to be very vigilant and we have to take care of this particular thing, because today we are all into online banking and all those things. There may be certain problems related to hacking, cyber crime, and all those things. So, usually we see in the banks the four types of deposits: savings deposits, recurring deposits, or fixed deposits, and the current deposits. The amount of reinterest that is being provided on the current deposits is very, very less. It is the peculiar feature of the current deposits. Even on the recurring deposits, also the type of the amount of interest that you are going to get is going to alter depending upon the policies that are being framed by the government. And the very important features of the savings account, for the information, we see the savings account can be opened with a bank or financial institution to earn interest on the balance maintained. So whatever the balance that is going to be there, a nominal amount of interest is being allowed by the banker. And this account should be opened with the objective of storing money in electronic form. These days, most of the savings bank accounts can be used for multiple purposes also, like paying bills, quick transactions, easy credit, etc. So it offers high liquidity and is very popular among the masses. It does, however, have cash withdrawal and transaction limits to promote digital payments. So today we have got cash and all those things through which we are going to make the payment for our electricity bills, water bills, corporation property tax, and all those things. Banks provide an interest rate that is only slightly higher than inflation, so it is not very optimal for investment. The interest provided by public sector banks is only 4%, very minimal it is. However, some of the private banks like Yes Bank or Kotak Mahindra Bank, they are offering the highest rate of interest on this particular savings bank account, which may range from 6 to 7%. Then we have got the what is considered as the uh, what we consider it as the recurring deposits. It is a special type of term deposits where you do not need to deposit a lump sum savings. Rather, a person has to deposit a fixed sum of money every month. So, fixed sum of money you are going to deposit, which can be as low as rupees 100 per month. So, in multiples of hundreds, you are going to make deposits, or it may be in terms of thousands also, where a compulsory amount is going to be deposited, and it is not the amount of money that you are going to leave in the bank account. That is called as recurring deposit. And you can choose a recurring deposit when you want to inculcate the habit of savings regularly, and you do not have a lump sum amount to set aside. Next, the interest rates on the recurring deposits range from 5% to 7%, and varying rates are offered to senior citizens also. These accounts have maturities ranging from 6 months to 120 months. You can also give a standing order to the bank to withdraw a fixed sum of money from your saving account on every fixed date, and the same is credited to the RD account. However, the bank may charge some penalty for delay in paying the installments and all those things. So another unique feature of this account is that you can take a loan worth 80 to 90% of your deposits. Even this is available even in the fixed deposits also. Suppose if you have got a fixed deposits of 1 lakh rupee, and 1 lakh rupee, whatever the amount that you want to get there, the banker, when you go and ask them that you want to avail the loan facility, the banker will say, sir, you have got the fixed deposits. Why not you take the loan in the fixed deposits that you have kept, and you can regularly contribute to that particular account only. And once again, it is going to be a full-fledged deposits only. So the rate of interest is being normally rate of interest is being charged, which may vary from 7 to 8% or 8 to 9% on the fixed deposit amount that you have deposited, on which you are going to take the loan or you want to avail the loan. Current account is a special type of account that has low restriction than a savings account when it comes to withdrawals and transactions. So it is also known as demand deposit account, and it is meant for businessmen to conduct their business transactions smoothly. And you can take into consideration that this particular bank also offers overdraft facilities on this. That is, they let account holders withdraw more money than there is in the account. So banks will also give the overdraft facility for the current account. So moreover, there is no minimum balance required to be maintained in the current account, unlike in the case of the SB account or the other accounts. So with the advancement of digital payments, banks also offer the best online banking facilities to these accounts also, which has helped them to contribute more to developing businesses in the economy. So the very important disadvantage of this accounts is that banks do not pay any interest on the current account balance. So whatever the amount that you are keeping in the balance in the form of the current account balance, the banker will not pay for you anything in the form of the interest, because at any point of time you can withdraw the money from the current account. That's why the banker will not allow any interest for the current account balance. Also, these accounts also charge FT fees for their services and maintenance. Next, we take into consideration the fixed deposit. Fixed deposit is an investment avenue offered by the banks, financial institutions, and non-banking financial companies, which we call it as, or we term it as NBFCs, that offers guaranteed returns with an interest rate ranging between 5 to 9%. So you can maintain the fixed deposits in the banks. It gives higher interest rate than the regular savings bank account, and it is going to offer a very wide range of tenures, ranging from 7 to 10 years. You should also try out a fixed deposit account when you want to build your habit or investing, but your risk appetite is quite low, since it offers guaranteed returns for you. So you can think of that it is going to build up a habit of savings, and you can also make investment, and you are going to get a guaranteed rate whenever you are going to open a fixed deposit account. And you may or may not have a separate bank account to open a fixed deposits with the bank. These days, banks are also offering FDs, which allow the tax exemption up to rupees 1.5 lakh per year under Section 80C of the Income Tax Act 1961. So under Section 80C of the Income Tax Act, the interest that you are going to get up to rupees 1.5 lakh rupees is being exempt from the tax. Another benefit with the FDs is that it is the interest amount which is going to be earned below the 40,000 for the poor class people or the low income group people. If they have to give a what we say the signature on the or bank tax saving, this one, that my income is not up to the mark, my income is very low, and I am leading the life on the basis of the interest that I am going to get. So for those particular people, low income bracket people, you are going to be totally exempted. and it is going to be up to rupees 40,000. So you can see up to 40,000 they are being subjected to tax deducted at a source TDS. Just like a recurring deposits, you cannot make any premature withdrawals, but you can prematurely shut down the deposit. So you may be charged some penalty because you are going for the premature closure of the FD account. Usually they are going to give you 7% means when you go for a premature deposit. For example, you have kept a fixed deposits of rupees 1 lakh in a particular bank. First year, second year, you have taken the interest. Third year, immediately you go and say that you want to withdraw the money. So at that time, the banker will say that we have given the interest for you at the rate of 7%, and the tenure that you have kept the money in our account, in our bank account, was 5 years. Now you are withdrawing prematurely. So we are going to cut the interest, and whatever the extra 1% or 2% extra they have given for us in the form of the interest, it is going to be recovered from our account. However, with the focus of the government to have a bank account for everyone under the scheme of Pradhan Mantri Jan Dhan Yojana, you can open a bank account for free if you do not have any one and enjoy various facilities offered by the banks as such. So you have these particular options that you take into consideration. And the next one is you are going to see what is the difference between the mutual funds and the bank deposits. Some problem, some doubts may be there in your mind. So the answer for that is a fixed deposits offer pre-decided returns and does not change throughout the tenure of the investment. If the RBI has told all the scheduled banks and the private companies also that you can go ahead with the giving off so much of interest, your interest may be around 7% or 8%, and that particular amount will continue for a very longer period. And that particular will act as a fixed source of income for the investor. But in the case of the mutual funds, it is a different one because mutual funds are being invested in the gilt-edged securities or in the open market, in the IPOs or in the corporate equities or the debts, and it is all always market driven. So if you are going to do very well in the market, then the SBI mutual funds or some other mutual funds, public or private, or this particular mutual funds are going to pay a very high rate of returns for you. Otherwise, if they are not performing well, there are every chance that you are going to get a lower level of the returns on your mutual funds. Why do your savings bank deposits actually result in a loss? Usually, as per the prevailing laws in the Banking Companies Act, whatever the money that we have kept in the bank accounts in the form of the SB balance, that is savings bank account balance, it is not going to attract because at any point of time you can withdraw the money from the bank. So the banks have made it compulsory that whatever the money that is going to be there in the company, it is going to be kept there. You see that this particular savings bank account is not going to earn any rate of interest at all. And even if they are going to allow a little portion of the interest, it is going to be allowed a very nominal interest is going to be paid for. Then how do bank deposits help the nation's economy? The banking system helps in channeling funds from savers to bankers. So you see that who are the people who wants money, they are going to borrow from the bank. And for that particular purpose, the banks have to mobilize the deposits from the people who have got excess. So for that particular purpose only, we are going to call a banker is a person who is going to be in debit center. He is going to borrow from the people who are going to have excess money, and the banker will ask them to come and deposit the money in the bank account. And for those people who want money, they can come and borrow the money from the bank. So the bank is going to charge you certain amount of interest is to be paid by the borrower, and the difference between the borrower's interest and the person who has deposited the money in the bank, that constitutes the profit for the banker. The next question that arises in our mind, how do bank deposits help the nation's economy? So the banking system helps in channeling funds from savers to borrowers by the process of taking deposits and making loans. So the next thing that we are going to study about the risk and return. So what is risk and what is return? We are going to study. Even though in the financial management or in the financial language, in the financial jargon, we are going to say that this particular risk is somewhat uncertain. So if everything would have been certain in the business that we are going to carry out, there would not have been any risk at all. So risk means what? In investing, risk and return are highly correlated, because we say more the risk that you are going to take up in the investment, more is the return that you are going to get. If you are not taking more risk means, then you are going to get a very low rate of return on the investments that you are going to make. Say, for example, the bank deposits are the safest means of deposits for the customers. So even though it is the safest, we see that the rate of interest that they are going to get on this particular investment is going to be very, very nominal asset. So we should be very careful before we go for the investment in the bank deposits. The another important thing that we are going to take into consideration, the banking industry in India is very, very large, and we see that this particular banking industry is going to make an investment, allows the customers to get the interest at a very nominal rate, because the amount is being backed by the government. There will not be any insolvency or something like that as regards this particular bank investments are being considered. So the next important thing that we take into consideration relating to this is the investment that we are going to make in the high risk category. High risk category, usually we take into consideration the investment in the open market, in the IPOs. If you are going to make investment and all those things, you are being assured a high rate of return if the market is going to perform where you have made the investment in the equities and in the bonds or in the debentures in the primary market. It is going to fetch you a very high rate of return. But at the same time, the risk is going to be very, very high. So in investing, risk and return are highly correlated. Increased potential returns on investment usually go hand in hand with increased risk. So different types of risks include project specific risk, industry specific risk, competitive risk, international risk, and market risk. So return refers to either gains or losses made from trading a security. So you are going to be exposed to different types of risk, like we have got project specific risk, industry specific risk, competitive risk, international risk, and market risk. Now let us study these particular things in a very wider way. What is this project specific risk? There are certain venture capital projects where a particular person is going to make huge investment in those particular projects, and because of the investment that he is going to make, he is going to earn a very high returns also. That is considered as he is taking up a particular venture in the form of a project, and for that particular project he is going to get a return. But that particular project is going to have its own problems related to the risk. The second one is the industry specific risk. For example, if you are making investment in the financial services sector, for example, factoring services or venture capital financing or lease financing or house financing, or in some type of the business where you are making investment in the cement industry, textile industry, or in the electronic industry or electrical industries. Each particular industry has got its own risk, and you have to make the take up the risk that is being associated. Then competitive risk is also there, because you are not the only person who is making investment, or you are not the person who is only lending in the market. Like you, there may be so many banks, institutions, financial institutions who are lending in the market, and they may lower the rate of interest, and usually the people will go to that particular bank or the lender where the amount of the risk that they are going to be getting is going to be very less, because the risk happens to be in the form of what we consider it as the risk that is being associated with the investment pattern. Because you see, when a particular person is going to tell you that he is going to have a very good amount of competitive risk, he is likely to get a very high amount of return also, because risk is more, return is also more. So competition, when a particular person is going to opt for, he will go and usually borrow from the financial institution where the rate of interest is going to be very less. The second one is the international risk. In the international risk, we are going to take into consideration that this particular, the rate of interest are for the big borrowers, the giant financial institutions, and those particular people who are going to borrow from this particular institutions. They borrow in terms of thousands together and lakhs together, crores of investment that is being risked. If a particular bank is going to provide you at a interest-free loans and all those things, so international risk is going to be there. So much of the state government, because we have got a federal structure in our country, the central government, if the state governments runs out of the problem because of the finance, they can borrow from the other sources, from the World Bank or from some other international monetary fund, IMF and all those things. And the market risk is also going to be there, because how the market is going to perform, based upon that you have to take into consideration the other important risk. The next one is return, refers to either gains or losses made from trading a security. So when you take into consideration the trading that you are going to make, you should be allowing this particular things in the consideration where you are going to take into consideration that you are going to have a high risk of risk. Very, very important aspect that you are going to get a very high rate of return also at the same time. Next, the return on an investment is expressed as a percentage and considered a random variable that takes any value within a given range. So you have to see that several factors influence the type of returns that investors influence the type of returns that investors can expect from trading in the markets. Diversification allows investors to reduce the overall risk associated with their portfolio, but may limit potential returns. Making investments in only one market sector may, if that sector significantly outperforms the overall market, generate superior returns. But should the sector decline, then you may experience lower returns than could have been achieved with a broadly diversified portfolio. That means to say, you have to take into consideration the important analysis that we take into consideration, that you have to make investment in the diversified portfolio. Like you can go for opting the bank fixed deposits or post office savings account, making investment in SBI mutual funds, or making investment in equity market or in the debt market as such. So what happens when you have diversified your investment, there is every chance if one particular investment category is going to bring a low rate of returns for you, and that is going to be compensated with the high rate of returns that you are going to get from another particular source of investment that you are going to have. So like this, the investment strategy is to be adopted, whether you are an individual investor or you are going to be a institutional investors. The next important aspect that we take into consideration is relating to the what we consider it as the plan that is going to be there, relating to the investment strategies that is going to be there, because you have to construct the investment strategy in such a manner that you are not going to have any risk at all. But it is very difficult for you to find out a particular investment where you think of that there is no risk at all. Risk is always associated with whatever the type of the investment that you are going to do. But what the to mitigate the risk, you have to go always for the investment portfolio, or the portfolio that you are going to select should be a diversified one. So in the addition pertaining to the personal financial planning that we take into consideration, we have to think of that risk is always covered by the insurance policies. So the next unit is going to deal with as to how the risk return analysis is going to be done in the insurance sector. Insurance is a contract wherein the insured is going to be indemnified for whatever the loss or the pecuniary or the financial loss is going to be made good by the insurer. So it is a contract between the two party. The insured happens to be always the individual person, and the insurer happens to be always the person who is going to be the insurance company. And this particular insurance company is going to tell you that this particular thing becomes very much important, because there are so many companies which are going for the different types of the things that we take into consideration. And this is going to tell us that the insurance is going to be taken into consideration because you want to take up the risk. And this particular risk is going to be very much minimal when you go for the insurance plan, because we have got to name the SBI accidental insurance scheme is there. SBI accidental insurance scheme, if any person dies because of the accidents, for every 1 year, he has to pay a premium of just 1000 rupees for a life coverage of 20 lakhs. So the insurance amount is 20 lakhs, wherein the individual investor is supposed to pay only 1000 rupees for an insurance policy of 20 lakhs. So we have different types of the insurance policies, like the insurance policy may be related to life insurance. Life insurance policies are there, motor insurance policies are there, medical insurance is there. So these are the general insurance is there, and all those things. So as a personal financial planner, you should think of as to where you want to make the investment. When you speak about the insurance contract, in the insurance contract, we are going to see that the individual companies will come forward for the purpose of asking the indemnified, that is the insured person, to tell us whatever the truth that is there relating to the health of a particular person, or to reveal whatever the things that is open, and to see that we have got certain principles relating to the insurance. Usually we take into consideration. So in the insurance, what happens, there are going to be certain principles based upon which the insurance company can work. Number one is called as utmost good faith, ubermi fidei, we call it as. Is a Latin word which is going to tell us that we have to look into consideration that utmost good faith is to be taken into consideration by both the insured and the insurer. What is this utmost good faith means? Because we should have the trust in the companies wherever we are going to, and we should be in a position to tell us what the things are going to be, and we have to open up every truthful information for the insurance company. Company will be in a position to indemnify us on a particular safety point of view, because it is going to collect the premium from lots and thousands together of the people who are going to take up the insurance on their life, and they are going to contribute for the company. And this particular premium collection is going to be collected by the insurance company. And in the event of a particular death of a person, or the accident of a person, loss of a motor vehicle or something like that, the company will come forward for the purpose of making investment. Like that, the principle of the life insurance is going to be there. The first and foremost important principle in the insurance, the two in the life insurance, is utmost good faith. Second one is the principle of indemnity. What is the principle of indemnity? In case if something happens for the insured life, then that particular insurer company has to come forward for the purpose of indemnifying the loss that is going to happen for the individual life. If the company do not come forward for the purpose of making loss, making good the loss that is that has been occurred for a particular person, then that particular person going for an insurance company for the purpose of indemnifying his life is not going to contribute anything. So how to diversify the reduce or eliminate farm specific risk? We are going to take into consideration. First, each investment in a diversified portfolio represents only a small percentage of that portfolio. So thus any risk that increases or reduces the value of that particular investment or group of investments will only have a small impact on the overall portfolio. So second, the effect of firm specific actions on the prices of individual assets in a portfolio can be either positive or negative for each asset for any period. Thus, in large portfolios, it can be reasonably argued that positive and negative factors will average out so as not to affect the overall risk level of the total portfolio. So the benefits of diversification is going to be taken into consideration because we have to diversify. Next, we have the different types of the models that we go for the comparative analysis of the risk and return. They are being very popularly referred to as the risk return models. Number one is the capital asset pricing model. We call it as CAPM in the abbreviation form. Second one is APM. The third one is multi-factor model. The fourth one is the proxy models. And the fourth one is the accounting and debt-based models. So for investments with equity risk, the risk is best measured by looking at the variance of actual returns around the expected return. So in the CAPM, that is capital asset pricing model, exposure to market risk is measured by market beta. The APM and the multi-factor model allow for examining multiple sources of market risk and estimating betas for an investment relative to each source. So regression or proxy model for risk looks for firm characteristics such as size that have been correlated with high returns in the past and uses them to measure market risk. So on investments with default risk, the risk is measured by the likelihood that the promised cash flows might not be delivered. So you see that by default there may be some problem. So the risk is measured by the likelihood that the promised cash flows might not be delivered sometimes. Investments with higher default risk usually charge higher interest rates, and the premium that we demand over a riskless rate is called the default premium. So wherever the risk is very less or riskless rate, we call it as default premium. Even in the absence of ratings, interest rates will reduce or will include a default premium that reflects the lender's assessments of default risk. These default risk adjusted interest rates represents the cost of borrowing or debt for a business. The next important thing that we are going to study with regard to these things is with regard to the different types of insurance plans that a particular person is going to take all about with. So we take into consideration the important aspect that we take into consideration, that is with regard to what are the different types of the insurance policies that are being available. We have, strictly speaking, we have got the endowment insurance plan, comprehensive endowment plan, and all those things. So we take into consideration the different types of the insurance plans that we have got, and we take into consideration how these particular insurance plans are going to be unique, and what are their features, what is the premium rate, and all those things. We are going to deal with those things in a very different manner. So different types of insurance plans may be either they may be endowment insurance plans, or they may be the we have the endowment or the comprehensive endowment plans. So we take into consideration the very first important aspect that is related to, that is what we consider it as the very important one, that is the life insurance plan. In the life insurance plan, when you go for the endowment plan, you are going to see that it is going to be covered over a period of time, and you are going to see that you are going to pay the premium every year. Usually for the salary class of the employees, you are going to see that SSS scheme is being introduced by the LIC, and they are going to take it into consideration. And this particular insurance plan will help us. The insurance plan is going to be there, which is going to be taken into consideration well. The important aspect that we take up the insurance plan is for the diversification purpose. So we require this particular thing. Usually, the people will take into consideration the different life insurance and other things because they have to diversify their portfolio, and it is only the insurance company which will come forward for the purpose of insuring the life of their particular individual. And this is going to be made known only at the time of when there is a loss of life, or when there is loss of motor vehicle or the other assets, because the company will indemnify whatever the loss that is going to occur for a particular person. And in the times to come, we are going to take into consideration the different types of insurance plans that are going to be there. Today, we are going to speak on the endowment insurance plan. We are going to speak on the whole life plan period, and we are also going to speak on money back insurance policy and all those things. Each one of the insurance policies that we are going to take up, we are going to have the different types of features and all those things. So let us look into as to what are the premium options that are available under the different plans and all those things, and we are going to study. So we have got the life insurance, we have got motor insurance, we have got health insurance or medical insurance, we have got property insurance, travel insurance, mobile insurance, cycle insurance, and we have got a different type of the other instruments also. And we also take into consideration the different insurance policies that are there available in our country. For example, we can take into consideration the things like in the insurance plan, some other problems are going to be there. And the people who want to take up the risk, they always take into consideration whatever the features that are going to be available, they take into consideration the important aspect. For example, in some plans, you may be having a very high premium rate, and usually even the private player also there in the insurance company, and the insurance policy, insurance sector is also taken well care of by the private sector in India, because we have allowed the foreign direct investment. And in the foreign direct investment, usually the private players will come into consideration, and they are going to have their own role in these particular aspects. The FDI is being allowed, and there is much more competition that is going to be there in the insurance sector. And each particular company will tell us that they are the best, because they want to go for the different types of the premium amount they want to collect. And each particular policy as is going to show, or it is going to have different types of the insurance premium and all those things. We take into consideration the different life insurance policies that are being offered, and we take into consideration those particular things are well taken care of. For example, in the case of the risk, when we speak about where the risk is going to be there more or something like that, we take into consideration. And the risk is going to be much more in the different types of the insurance, how the things are going to be carried out, because we have the what is called as the actuarial scientist. Actuarial scientist, they are very much highly paid. They are the people who are going to get high remuneration, and they are going to calculate based on the lifespan of the people. If a particular person is going to take up a insurance policy at the age of 25, the insurance policy premium that he is likely to pay is going to be very, very less when compared to a particular person when he is going to take up an insurance policy at the age of 52 or 53. The life premium, insurance premium that he is to pay is going to be 4 times, 5 times higher than when the retirement plan, when the retirement age is fast approaching for him, because he is at the verge of 53 or 54 age. When you have taken the policy at 25 years, it was very less, the premium. But now it is become very 4 times or 5 times bigger than that, or even much more than that. But because your age is now 54 years. So the term life insurance policy, the term life insurance, we call it as the policy. In the term life insurance policy, it is going to provide you full risk cover against any type of the eventuality that is going to occur. That means to say you are going to have the full coverage of the risk. Then we have got the whole life insurance. In the whole life insurance offers life insurance coverage till 100 years of age. Whole life insurance means it's going to give you the insurance coverage till 100 years of your age. And endowment life insurance policy we have got, it provides the combined benefit of life insurance come saving. So there is a combination of the life insurance, and also saving is also there. The next one I was telling you with regard to the money back insurance policy, provides periodic returns along with the benefit of life insurance cover. That means to say your life is covered, but whatever the premium that you are going to say for example, you are at the age of 30 years now, you want to take up a money back policy of 20 years. So up to the age of 50 years, for every 5 years, your money is going to be returned to you. So you have taken up a policy of 50,000, let us assume, and at the age of 50,000, for every 5 years, you are going to get back 12,500 rupees, 12,500 rupees, 12,500 rupees in the third quarter. And at the end, fourth quarter, when you reach 50 years, you are going to get the full amount, less whatever the amount that you have previously received. The very important advantage of the money back insurance policy is whatever that money premium, the insurance policy premium that you have paid, it has been reimbursed to you. That means to say your money is not kept by the insurance company and it is being reimbursed to you partly. Next, we have got savings and investment insurance plans. Under this particular plan, it provides an opportunity to save and gain long-term investment return. So it is going to propose for you to save a proportion of your income, and also you are going to gain out of the long-term investment returns that you are going to have. Then you have got retirement insurance plans. It is going to help you to create a retirement corpus so that you can retire gracefully. Next, you have got ULIP life insurance policies, then it's unit linked insurance policies. It offers the benefit of investment life insurance. So it is going to provide you the benefit, a dual benefit. One is benefit of investment, and another one it is the benefit of life insurance. And you have got child insurance policy. You can take up the insurance policies on the life of your children also. Helps to secure the future of your child. Then group life insurance plan offer life insurance coverage to a group of people under a single plan. So let us look into what are the different types and the important characteristic features of the different types of the insurance policies that we have got in India. Number one is called as the term life insurance policy. The term life insurance policy is a type of life insurance that provides a death benefit to the beneficiary only if the insured dies during a specified period, and if the policyholder survives until the end of the period or term, the insurance coverage ceases without value and a payout or death claim cannot be made. Term life insurance is income replacement that remains active for a specified number of years. So term life insurance is one of the most affordable types of life insurance. So it can further be classified into term insurance, decreasing term life insurance, and increasing term life insurance. So the second part here, we are going to deal it as whole life insurance. What is the difference between the term and the life? Here, if the person is going to survive even after the term is over, then the death benefit is not given under the term life insurance. In the whole life insurance, it is going to cover him for a period of whole life insurance is an insurance plan that provides you coverage throughout the lifetime, provided the policy is in force. So you have to keep always the policy in force. Whole life insurance policies also contain a cash value component that increases over time. You can withdraw your cash value or take out a loan against it as per your convenience. In addition, in case of your unfortunate demise, you are going to be pay back the loan. The death benefit paid to your beneficiaries will be reduced. And the third one is called as the endowment policy. As the name itself is going to define, an endowment policy is defined as a type of life insurance policy that is payable to the insured if he or she is still living on the policy's maturity date or to a beneficiary otherwise. So endowment life insurance plans provide you with a dual combination of protection and savings. In this policy, if the insured dies during the term of the insurance policy, the nominee receives the sum assured plus the bonus or participating profit or guaranteed additions. So if any, the bonus or profit is paid for the number of years that the insured survives in the policy term. The next one is the money back policy. As the name itself emphasizes, money back policy gives you money during the policy tenure only. So it gives you a percentage of the sum assured at regular intervals during policy term. Say, for example, if you have taken up a money back policy for 1 lakh rupee for a interval of 5 years, if you have taken up the policy for 20 long years, so for the break of 5 years, every 5 years, you are going to be paid 25,000 in the first and second quarter, and in the third quarter, you receive another 25,000. And the balance amount, along with the bonus earned on the policy, will be given to that particular person at the end of the 20th year. But in case of an unfortunate event before the full term of the insurance policy is over, the beneficiaries are entitled to receive entire sum assured regardless of the number of installments paid out. So money back policies are the most expensive insurance options offered by insurance companies as they provide returns to the insured during the policy tenure. Money back policy gives way for a person to plan the course of his life with a sum that is expected in regular intervals. So plans such as children's education, children's marriage can be executed in a better way with the help of this policy. The next one is the savings and investment plans. Savings and investment plans are the types of insurance plans that provide you the assurance of lump sum funds for you and your family's future expenses while providing an excellent savings tool for your short-term and long-term financial goals. These plans assure your family a certain sum by way of an insurance cover. So this is a broad categorization that covers both the traditional and unit-linked plans. Then next comes the retirement plans. These plans provide you with the income during retirement is called the retirement plan. These plans are offered by life insurance companies in India and help you to build a retirement corpus. On maturity, this corpus is invested for generating a regular income stream, which is referred to as pension or annuity. So, retirement plans are usually for the purpose of seeing that you are going to lead a very stress-free life after your retirement. The next one is with regard to the unit-linked insurance plans, ULIPs. ULIPs are a type of insurance plan that provide you with a dual advantage of the protection and the flexibility in the investment. It is a type of life insurance where the cash value of a policy varies according to the current net asset value of the underlying investment assets. The premium paid by ULIPs is used to purchase units in investments assets chosen by the policyholder. So whatever the assets that you opt for to be purchased by your money, the company is going to make the investment in that. The next one is the child insurance policy. As the name itself is going to suggest you that a child insurance policy is a saving come investment plan that is designed to meet your child's future financial needs. So whenever your child is going to grow up and is going to enter the schooling at the time for the purpose of paying the school fees or the college fees, you require money, and for that particular purpose the child insurance policy may be taken up, and it allows your kids to live their dreams and gives you the advantage to start investing in the children's plan right from the time the child is born, and provisions to withdraw the savings once the child reaches adulthood. So some child insurance policies do allow intermediate withdrawals at certain intervals. Some policies are going to allow, but not all the child insurance policies to be withdrawn at the intermediate level. Next, the life insurance is not just to fulfill the daily expenses of the family in the absence of the breadwinner. It should be capable enough to bail out the family during large financial emergencies. So one should always choose one or two best types of life insurance which can support his or family in different stages of life. The next we are going to study about the group life insurance. Group life insurance, as the name itself is going to suggest, is a type of life insurance coverage that is provided to a group of individuals, generally employees working in a company or organizations or in the government organizations, in the universities. The main purpose of the group life insurance plan is to offer financial freedom, support, and protection to the family of the concerned employee in case of any eventualities. So in case of the employee's death, when employed with the company, the corresponding group insurance plan would offer the much required financial guarantee to the inconsolable family. So this policy is not only limited to an employer-employee group, but also extended to other organizations like bank customers, non-banking financial organizations, NGOs, microfinance institutions, and professional groups. Some group insurance policies also offer coverages for outstanding loans to a group of debtors, while some come up with a disability and critical illness benefits. Next, we take into consideration how do you select the right type of insurance or the life insurance policy. So you have to, firstly, you have to look into your goals, set expectations that you expect from the life insurance company, and other expenses that may crop up during your lifetime. Second one, you have to look for the plans that will give you and your family to keep them in a stabilized position, and check out the best insurance companies available in your geographical area, in your country, and the different types of the plans offered by them, and whether you want to opt for the term life insurance, or you want to go for the children policy, you want to go for endowment policy, or you have to go for whole life policy, or you want to go for retirement policy, that you have to opt. Different plans will be offered by the different companies. For example, you want to they give, the insurance company will give the advertisement, be at 60 what you are at 30. That means to say, even at the time of your retirement, you need not be worried, because you are going to have your own the this one, because you will be having some financial and economic benefits, so that you need not depend on any other, your son or daughter or your brothers or your some other person to take care of you, because at the time of the retirement, you are not going to get any salary at all. You are only going to get a pension. Pension is going to be normally 50% or 40% below what the regular salary you are going to get. So that may not be sufficient for meeting all your exigencies, no? So you have to plan up your insurance policy, the life insurance policy that you want to take up. If it is good for you, you can opt out even for the money back policies also, where it is going to enable for you that you can get regular at the regular different intervals. The money is going to be given back to you. Or you, otherwise, if you are not able to take any decision pertaining to what type of the policy that you want to get, you can always consult an advisor with regard to the insurance. Most of the times, the insurance agents will come and they are going to speak to you as to what are the different types of the insurance plans that are there, and which one is more profitable, which is going to serve your purpose, and all those things. So next important thing that we are going to take into consideration is what are the different advantages that you are going to get out of the insurance plan. The primary benefit that you are going to get out of the insurance policy is financial protection and the safety. So you are going to be given certain amount of uh, financial protection, because you are going to get the lump sum amount that you at the time of the termination of the contract, or you are going to get the safety, because you are in the absence of you, your family is not going to be put into a lot of trouble. A sudden demise is not going to make you to get into any problem as such, and the life coverage is going to be there. Your life is going to be covered to so much of amount. As I was telling you, in the accidental insurance policy, your life is going to be covered for a very paltry sum of money, like 1000 rupees. You are going to be given a life coverage of 20 lakhs by the State Bank of India, SBI accidental insurance policy. Then investment options are there. Whatever the money that you get at the end of the policy, you may reinvest that particular amount with the insurance company only. They will allow you to make the deposit and you can get back. If you are at the time of retirement, if you are going to get around 30 lakhs or 40 lakhs or 50 lakh rupees, that 40-50 lakhs can be kept with the insurance company, and they are going to give the money for every month for you in the form of the retirement, and some tax rebates are also made available to you. And we have the long-term savings that is available, because over a period of time, without your notice, from your salary, the amount is going to be deposited in some banks or in the insurance company. Then you are entitled even for the tax saving benefits under Section 80C and Section 10D of the Income Tax Act 1961. Then another important thing that you take into consideration, what is the insurance premium that you have to pay under the term insurance plan. A term plan with the return of a premium option is a type of term insurance plan, but with an exception of maturity amount. This policy refunds all your premium amounts if you outlive the policy term. So next we are going to take into consideration what is the difference between the whole life and the term life insurance. So in the whole life insurance, it lasts lifelong until the policy is in force. And in the case of term life insurance, it lasts for a specified tenure only. Then it has high It has cash value, like whole life insurance, but it doesn't have any cash value. And in the whole life insurance, it high rates of premium is charged, but in term life insurance, low rates of premium is charged. It is suitable. The whole life insurance is suitable for individuals looking for long-term investment plus insurance, whereas term life insurance, it is suitable for individuals looking for short-term insurance along with the good coverage. And the last but not the least, the difference between the whole life insurance policy and the term life insurance policy is that of, in the case of whole life insurance policy, premium rates are high initially, but stay constant as time passes. But in the case of the term life insurance, premium increases at every renewal time. So we have looked into the different types of the insurance policies that are being offered. Then next we are going to look into the different types of the general insurance plans. The general insurance plans may be either they may be with regard to the motor insurance, there may be with regard to the fire insurance, or it may be the marine insurance and all those things we are going to study. For example, if the businessman is going to take up the insurance because he has got the warehouse and all those things, and the businessman wants to take up the insurance on that, it is called as fire insurance. Because if suddenly if there is any uh, loss occurring on account of the water, that is when they are transporting it from the one country to another country on international assignment, then it is considered as marine insurance policy. So marine insurance covers the loss or damage of ships, cargo, terminals, and any transport by which the property is transferred, acquired, or held between the points of origin and the financial destination. So, what are the different types of marine insurance policies? We have got floating policy, we have got voyage policy, time policy, mixed policy, named policy, port risk policy, fleet policy, single vessel policy. All these types are the different types of the marine insurance policies that we have got. So what are the why marine insurance is very important for us? Marine insurance provides comprehensive coverage by protecting your shipment from various perils such as theft and piracy, fire, explosion, natural disasters like storms, hurricanes, earthquakes, cyclones, collisions, derailments of land conveyance, the sinking of ships, apart from covering various expenses. So, what are the five principles of marine insurance? The fundamental principles of marine insurance are drawn from the Marine Insurance Act 1963. As in all contracts of insurance on property, the contract of marine insurance is based on the fundamental principles of indemnity, insurable interest, utmost good faith, proximate cause, and subrogation and contribution. So, what does it mean? For example, the two types of marine insurance policies, that is marine cargo insurance, relates to cover for cargo during transit, and next one we have got the hull insurance relating to ships, and we have got the other different types of marine insurance. Next, we take into consideration the other important aspects of the fire insurance. So, if there is loss of property, loss of goods because of the fire, it can be made good with the help of the fire insurance policy. That is another important general insurance policy that is being taken up by the people. What is fire insurance? You take into consideration, it is the provision against losses caused by fire, lightning, and the removal of property from premises endangered by fire. The insurer agrees for a fee to reimburse the insured in the event of such an occurrence of the fire. And what is like fire insurance, and how what are the different types? So we have got fire insurance helps to cover the risk of loss of property caused by the accident or unintentionally. A fire insurance policy covers the loss that the insurer may suffer due to the destruction or damage of the property to the goods caused by fire during a specified period and up to agreed amount. Say if you have taken up a policy for 1 lakh, the cover is going to be up to 1 lakh only. So what are the different types of the fire insurance? All those things we are going to take care of and we are going to study. So what is the eligibility criteria and all those things we are going to study in detail. So protection against any loss or damage caused due to any movable or immovable object that turns into a fiery fiery explosion. That is, fiery explosion is going to be there. Then protection of the fire policy is going to be taken into consideration. Covers property damage such as furnishings, office building, machinery, stock, etc. That is going to be very important. And we take into consideration, besides fire perils, a burglary insurance policy also provides coverage for the damages caused due to any natural calamity that may be in the form of explosion, bursting of the water tank, etc. What are the different types of fire insurance in India? There are different types of fire insurance policies in India that you can purchase. Number one is called as Bharat Sukshma Udyam Suraksha. Bharat Sukshma Udyam Suraksha is a policy that provides coverage for the loss or damage caused to the building, property, plant and machinery, stocks and other assets for a sum insured up to rupees 5 crores. So up to 5 CRs if the property is being damaged or if the loss is there because of the loss caused to building, property, plant and machinery, stocks and other assets. Second one is called as Bharat Lagu Udyam Suraksha. So here the loss is being covered to the extent of rupees 5 crores to 50 crores. So whatever the damage that is going to occur for the products in the building, plant and machinery, stocks and other assets. Next, we have got special fire and special perils. This is a type of fire insurance contract between the insurer and insured that provides coverage for the loss or damage caused to the building, plant and machinery, stock and other assets for a sum period, for a sum insured exceeding rupees 50 crores. Then there are other types of five policies specifically under special fire and special perils insurance. Those are being considered as number one, specific policy. A specific sum insured is determined coverage not only against fire related perils but also provides coverage against any other perils such as robbery, burglary, civil rampage, etc. And we have got another policy called as valued policy. At the intimation of the policy, the value of a particular property is determined. Instead of the current market value, the indemnity of the policy is determined, which is based on the value of the property. So the agreed value at the time of purchase is the deciding factor of policy indemnity here. Next, we have got the floating policy. If you deal with fluctuating stocks in different areas, this policy provides coverage for one or more goods at the same time under one premium and one sum assured. Next one is valuable property. The claim amount is decided according to the current market price of the damaged property. So what are the characteristics of the fire insurance? Number one is the important characteristics is number one, covenant of good faith. The policy is on the premise of faith between the insurer and the insured. It is essential for both properties to reveal all the facts at the time of policy initiation. Number two is covenant of indemnity. It is an indemnity policy wherein the insurer is liable to cover the loss that occurred. In case of a fire break with no loss, no insurance liability will be offered. Number three is 1 year policy. The term fire insurance policy is generally for a year, but it can be renewed depending on the terms and conditions mentioned in the policy schedule. Then we have got insurable interest. That is another important characteristic. The policy is valid when the insured has an insurable interest in the insured property. In case the loss is going to occur, such interest may be required. This is beneficial to the insured by the survival of the insured property, and under a situation of destruction may face a loss as well as. And direct loss is also going to be there. If the root cause of the loss or damage is fire, one may avail of this. And a personal right is going to be the another characteristic. In case of any loss, damage, under any unfortunate circumstances, the insured amount will be provided to the person whose name is mentioned in the policy document. Next one is personal insurance contract. The policy requires complete transparency. The insured must know the insured's behavior. Also, the insured can only transfer the policy with the consent of the insurer only, and the insurer has the right to terminate the policy if their possession of goods is transferred to a third property. So property description should also be provided. While buying a insurance policy, it is important to give a proper account of the property that you are under possession. This is very much essential because as per the location addressed in the document of the policy, the claims will be settled. If in any case unfortunate event occurs at the insured place, in case if there is any change, it needs to be brought to the notice of the insurer to avoid further upshot. So non-life insurance policies are also going to be taken into consideration. The next important thing that we are going to study is with regard to the fire insurance and what is the different types of the things that is going to occur and where the different policies are being taken. That is the fire insurance policies are being well taken in the different types of the things that are going to happen and it is going to cause damage, like in the form of the standard fire and allied perils policy, we call it as popularly known as FSSP, covers the following perils: fire, lightning, explosion, implosion, aircraft damage, riot, strike, malicious damage, storm, cyclone, typhoon, tempest, hurricane, tornado, flood and inundation, impact damage, subsidence and landslide, including rockside, and bursting and or overflowing of water tanks, apparatus and pipes, missile testing operations, leakage from automatic sprinkler installations, bush fire. It means fire spread from the bushes. So special policies are also being taken care of. The reinsurance does not cover the fire insurance does not cover the following risk known as the general exclusion. What are those particular things that are not being covered? The first one is the first 5% of each claim subject to a minimum of rupees 10,000 in respect of each loss arising out of act of God perils such as lightning, STFI, subsidence, landslide, and rock slide under covered under the policy. The second one is the first rupees 10,000 of each loss arising out of other perils in respect of which the insured is indemnified by the policy. The third one is the excess shall apply per event per insured: loss, destruction, or damage caused by war, kindred perils, loss, destruction, or damage directly or indirectly caused to the insured property by nuclear peril, loss, destruction, or damage to any electrical and or electronic machine, apparatus, fixture, or fitting, excluding fans and electrical wiring in dwellings, arising from or occasioned by overrunning, excessive pressure, short circuiting, airing, self-heating, or leakage of electricity from whatever the cause, loss of earnings, loss by delay, loss of market, or other consequential or indirect loss or damage, or any kind of disruption whatsoever, earthquake, volcanic eruptions, loss of damage due to terrorism, loss of damage by spoilage resulting from the retardation or interruption of or cessation of any process, loss by theft during or after the occurrence of any insured peril, except as provided under riot, strike, malicious, and terrorism damage, loss or damage to property insured if removed to any building or place other than in which it is herein stated to be insured, except machinery and all those things. Next, we are going to tell you about the non-life insurance policies. What is non-life insurance policies? We are going to study, and after this, we are going to study the conclusion part of this. So we are going to see that the non-life insurance policies, how it is going to be taken up, what are the things that we should be taken into consideration when you speak about the non-life insurance policies and all those things we are going to study. So the major difference between the life and the non-life insurance policies is related to: number one is the non-life insurance policies. They are going to be taken into consideration for the purpose of looking into we are going to look into the features, benefits, and all those things. And we are going to cite examples for the non-life insurance policy also. Those the non-life insurance policies may be in the form of the general insurance policies. The amount is specified in the policy is the sum insured, which during the policy period symbolizes the insurer's maximum liability for claims that is under the benefits of to the non-life insurance policy. The policy period of a non-life insurance plan is usually short. that is 1 year. The duration can be longer. The premium of the policy is paid right before the insurance company issues the policy. When an application for insurance is received by the company, they assess the risk involved depending upon the type of the risk that is being covered. So it is mandatory to take into consideration what are the benefits of the non-life insurance policy we are going to study. In case of health insurance, financial help is provided at the time of the medical emergency. It is mandatory by law to buy a third-party motor insurance policy. It can take care of the compensation to be paid to the third party in case of damage to the property or life. Then home insurance covers the residential property of the policyholder against many unforeseen incidents like fire, burglary, natural calamities, riots, etc. Travel insurance plans offer insurance coverage to senior citizens and children as well. So these help with issues like loss of baggage, accidents, loss of documents, etc. in a foreign land. Commercial insurance benefits the businesses with policies like employee benefits insurance, shopkeepers insurance, property and marine insurance. The policies of non-life available in India, we have got marine insurance, home insurance, travel insurance, health insurance, motor insurance, and commercial insurance also. So let us look into whether this particular non-life insurance, what is the difference between the life insurance and the non-life insurance. So the definition of the life insurance goes like this. Life insurance protects against life risk where the insured individual is promised by the insurance company for the uncertainty and the ambiguities that are going to be related to life, related to death. Whereas general insurance is the insured individual is promised to be compensated by the insurance company for the damage caused due to an unfortunate circumstances that is going to happen. The valuable things of the property, value or property are protected by general insurance. Policy issued for the life insurance is normally a long-term policy, but for the general insurance, it is a short-term policy. Whereas the nature of the policy, we say life insurance is acknowledged as an investment, and it is not a contract of indemnity. Whereas the general insurance, it is termed as indemnity contract because loss is going to be there for the businessman on account of the fire or on account of burglary or theft or aircraft damage or peril, volcanoes, and all those things. The policyholders receives the benefits of the insurance coverage in the case of the life insurance, whereas the policyholder will get the insured amount on the benefits of the insurance coverage. For how much he has insured, he will get the insurance amount. The sum assured is paid at the maturity of the policy or death of the policyholder, whereas claim is processed as per the damage or financial loss suffered by the policyholder. Then the cost of the policy, it depends upon the amount of sum assured covered by the insurance policy, depends upon the value of the insured asset. So what is the difference between participating and non-participating life insurance that is going to be there? Participating life insurance means the very important characteristic is the policy offers a share in the company's profit, that is participating. Whereas there is no profit sharing in the case of the non-participating policy. Bonus payout annually, the bonus is being paid in the case of the participating policy, but in the case of non-participating policy, no bonus is being paid. Premium higher than non-participating policy due to possible profit sharing, but in the case of the non-participating policy, it is lower than the participating policy. So benefits, dual benefit of insurance and share in company's profit is allowed in the participating policy, whereas no additional benefit is offered under the insurance cover or apart from the insurance coverage. And what are the examples of the participating policy? We take into consideration the unit linked insurance policies in OZA is one of the best examples of the participating policy, whereas term insurance is an example of a non-participating policy. So how to apply for the non-life insurance policy? Here there are certain reasons while buying the non-life insurance policy. That is number one, financial security at the time of need is one of the major upsides of buying a non-life insurance policy. Number two is the insurance company will bear the cost of the financial liability. Thus, risks are carried over to the insurance company from the policyholder. And lastly, peace of mind related to possible financial crisis is going to be there. So one important thing that we have to take into consideration in the case of the non-life insurance are specific to the type of policy being purchased. For example, the inclusion of a motor insurance policy, they are third-party liabilities, own damage, that is comprehensive policy, and a personal accident cover. Under health insurance, hospitalization costs, the cost of minor surgeries, ambulance charges, etc., is included. The inclusion of your insurance policy will be mentioned in the policy document. What are the exclusions of the non-life insurance policy? Some general exclusions of the non-life policy are arising a claim when the policy is not active, representing false or fraudulent information, producing fake documents, not raising the claim within the stipulated time, and not following the claim process diligent. So these are the exclusions from the non-life insurance policy where the claim is not going to be active. So the very important thing that we have to take into consideration while purchasing the non-life insurance policy is that you have to be very sure that things to be remembered at the time of purchasing the or remember renewing the non-life insurance policy. Check the terms and conditions of the insurance policy before policy renewal or purchase. They are available online on the insurance company's website. Also go through the fine print in case of doubts. Do not hesitate to get them cleared by contacting the insurer before you buy the policy. Compare insurance plans from different insurance companies and review coverage. Also compare the cost of each plan. And the third one, the most important thing to remember is buying a policy that is suitable for your needs. Do not buy coverage that seems unnecessary but good to have. It will only increase the premium. So we see that all these things are to be taken into consideration. Risk is going to be associated whether you are going to take up the insurance policy because you see that you are going to take up the policy on your life and that particular life is uncertain. And you see some people are going to take up the accident insurance policies also because when they are going to meet out with accidents and death is going to occur, the next kith and kin of their family is not going to be exposed to the financial emergencies, exigencies, and to safeguard them, the accidental insurance policies are going to be taken up. And risk return analysis, when we are going to take up insurance, is not an investment, but because of the unit linked insurance policies, today we see safety is given priority, and along with whatever the amount that is going to be there, it is the bonus is going to be added for that, and it is going to be given to the survival of the insurance policy or in the demise of that particular person, the next kith and kin of the family is going to be given the benefit of that. So we have seen that in our country, both the life insurance corporation, the general insurance corporation has been divided into four important subsidiaries: the Oriental Insurance Corporation of India, the World Life Insurance Corporation of India, the Oriental Insurance Corporation of India, Unit Linked, United Assurance Company. They are the different subsidiaries of the General Insurance Corporation. They are looking after the general insurance business in our country. The government of India has allowed the foreign direct investment in the insurance sector, and lot many competitions are taking place in the specifying the premium amount. And we see that Tata's and SBI and other nowadays there is a development in our Indian economy that most of the companies which were doing the insurance business, they are doing the banking business, and the banking companies which were into banking business, they are also taking up the insurance business. And added to this, we have the post office working under the central government ministries. They have also come out with the different accident insurance policies and all those things. And they are also offering the insurance business to the general public. Overall, looking into these particular aspects, we see that this particular insurance business is a roaring business because the India is one of the highest populous country in the world, next only to China. And as per the UNO report, it is being said that India is going to surpass China in the 2023, and our population, India's population, is going to be much more when compared to the population of the China. So India happens to be the very important marketplace where lot many foreign MNCs can come and the insurance companies can do a very good amount of business because the people who have taken up the life insurance policies in India for a vast population of 140 crores, it is not even crossing 5 to 10%. Even double digit has not been crossed. And with this, you can see that there is lot of scope for the potentiality in the insurance business. And the people are going to think about that India and China happens to be the very important good marketplaces for the purpose of doing the insurance business. And this particular risk and return is going to be there always because we see that risk and return is always associated with the investment because even when you go for the government securities, when you want to make investment in the government sector, you see that government securities are also backed up by the government, and you see that the government health insurance has also come up, and we have different type of the family government health insurance department and all those things where they are going to take up the things. We have got the family health insurance plan in the case of the government health, family health insurance plan and all those things. And family health insurance, we have got the senior citizen insurance and individual health plan, health companion, senior first, and all those things. These types of the health coverage plans are being taken into consideration. And to speak about the vehicle coverage plans, we take into consideration as to what amount of is being compensated when you go for the vehicle insurance and all those things. That is also being taken into consideration. We have the motor insurance policy, and the motor insurance policy is going to deal with these particular issues as to what are the problems that are going to be associated with that. And motor insurance policy, we see e-policy, that is electronic way we are going to take up the policy and all those things, and the things are going to be taken into consideration. And we see that these particular things are going to put an end for the life and the non-life insurance business. And when we want to tell you about the risk and return analysis as regards the investment is being considered financial planning. Financial planning, you have to start at a early age so that your life is going to be stress free at the time when you take up the insurance policy and all those things. And the financial policy that you are going to take and the financial planning that you are going to take, you have to take the advice of the people, and then only it is possible for you to look into those particular aspects, how best you can take up those particular issues that is going to be taken into consideration. And you see that if you are going to make investment in the gold or in the real estate sector, you may be earning a very steep capital gain may be there. But at the same time, if the gold rate is going to come down, the whatever the investment that you are going to make in the gold is going to be a wasteful exercise because from the last 4 to 5 years in India, we are seeing that the gold rate for every 10 grams is going to be around 45,000 to around 50,000 rupees only. So there is no speedy growth in the rate of the gold. And some people traditionally they think that whatever the amount of money that they are going to invest on the gold is going to be an financial planning and investment. But earlier it was there in the year 2004 or in 1960s or 70s, gold happened to be the highest amount of the money is going to be invested on the gold. But nowadays, we see because of the online marketing and all those things, commodity marketing, and also derivatives that have come up in the market. One thing that you should always understand with regard to the derivatives is you are going to derivatives is nothing but the assets whose value is being derived from the underlying assets. For example, you are going to deal with options, futures, and swaps. They are the different types of hedging contracts and all those things. Options, futures, swaps, they are also going to tell us about as to how the risk is going to be hedged by the individual or the institutional investors when they are going to make heavy investment for the in the market because they are going to be always aware of as to what the development that has taken place, and they want to study these things in a very different manner so that they are going to have the things into consideration. ಅವರೇ ಸಾಕು ಅಂತ ಅನ್ಬೇಕು.